Okay, welcome guys, welcome to another weekly market analysis session. It is Monday, the 7th of November. We've got a new cohort beginning with us today as well. So welcome to the new starters. But this session is mostly for the for the traders. Okay, so the traders and market analysts that have joined this session, we're going to focus and do an overview of what's taken place in the previous week and what to expect for the week ahead. We're talking about the fundamentals, some of the news that have come out over the course of a week or so, and we'll look at some of the technicals as well. But what I'm going to focus on at the moment is looking at the economic calendar, so from a macro perspective now. So before we begin and go into and do a deep dive into some of the key outcomes from last week's sessions, look at the central bank rates where they are at this moment. So this is ranked for us, but we can clearly see the US is at 4%. I don't remember the last time we've seen it at these levels, these elevated levels, right? So we see US at 4%, Canada at 3.75% base rate, QE 3.5%, the UK 3% in number of decades, right? Aussie at 2.85%, the euro at 2%. And we've seen the ECB having such a loose monetary policy for how many years? Being at zero, negative in that region there. Swiss also at 0.5%. And well, Japan, Bank of Japan hasn't really moved away. They're continuing with a accommodative stance, shall we say, but their inflation is not as elevated as it is in the rest of the world. But hey, we're seeing a differential between the yen and the other currencies. I mean, if you look at dollar yen, look at that differential there. There was a chart that I showed you guys a couple of weeks ago, which showed the difference there. But don't need to really touch on that this week. Okay, so what were the key points from last week? Let me just bring up last week. There we are. Right, we'll start with Aussie. Okay, so we saw last week on the 1st of November, overnight, we had the Australian rate decision, right? The RBA set their rates and their cash rate. We saw a rise in their interest rates. But here's the key point. Following on from the prior week to that, where we saw the Bank of Canada, yes, raise rates by 50 basis points, but at the same time, they gave more of a dovish pivot, right? We saw a bit of a dovish rhetoric that came through. And that was also followed suit with the RBA. The RBA also came out with a bit of a dovish tone in regards to what their outlook was in regards to their economic conditions. Now, the hope was, in the majority last week, was that we will see the same thing happening with the Fed. Okay, so the market started to price that in, that we're going to see that the Federal Reserve go into more of a dovish stance. And that's what Bank of America and a number of these institutions have started to sort of call out, right? We're going to see a shift in Fed rhetoric, even though we expect them to raise rates. That's sort of the key point there. And what did that promote? Well, clearly, if we're going to see a dovish pivot from most central bankers, most central banks, we're going to see equity markets begin to rise, right? Because that gives them a bit of hope, a bit of that there's not going to be such a strong tightening of conditions from an economic standpoint, right? But clearly, that's not what happened, right? So what we did see as we go into the week a little bit later on, we also had a few speeches here. Again, nothing to really worry about. It's only what we had the FMC. Now, going into Wednesday, we had the ADP, non-farm employment change number, that came out at a larger clip than expected previously. But at the same time, that wasn't too much of the concern. The focus was going to be on what was their rate decision. Now, markets already knew and already priced in a 75 basis point rate hike. So that was guaranteed pretty much, okay, that was going to take place. But what wasn't anticipated was the fact that instead of having a dovish pivot, we saw them come out more hawkish than anticipated. Okay, so we heard from Chairman Powell, Jay Powell, comes out with very hawkish commentary regarding his expectations of higher than expected of a rate peak. Right? So now we're looking at them to continue raising rates into next year and not slow down. There is no slowing down at this current moment, right? So yeah, that was the sort of the key point there. So we see now that the rate is at 4% now, going up by 75 basis points from 3.25. Then we go into the week, and on Thursday, we also had a rate decision made by the Bank of England. Okay. Now, I spoke last week about, if you've seen the previous session, where a lot of the fiscal side, what's taking place from a political standpoint, right? We put a lot of focus on those areas. I'm not going to cover that again. Have a look at the previous video, and I did a deep dive of what's happened in the last few months in regards to the UK political scene. But moving away from that, the focus in the previous week was the Bank of England. Okay, now, yes, we expected another rate rise from the Bank of England. Again, following the Fed, we saw a 75 basis point rate hike, and it's the highest that we've seen. Rates, being at 3% for over 30 years now, okay. Now, what was a concern in regards to that rate hike was the rhetoric that we heard from Andrew Bailey. So Andrew Bailey is in charge. He's the man, heading up the central bank, the Bank of England. And this is someone that's come from the FCA. So he was originally sort of, managing the FCA. Now he's taken over from Mark Carney as the chairman and the governor of the Bank of England. Now, his first few meetings, I do remember happening over the last year or so when he stepped in as the governor. His first few meetings were very shaky. Let me just say that, right? So his first few meetings were very shaky. But I also I saw the same thing happen with Jay Powell when he took over from Janet Yellen. But okay, moving away from that, he is still giving that same rhetoric where he is very concerned about the economic conditions that we see ahead of us in the next 6 to 18 months. Okay, so he's giving us that strong opinion that we are going to go into a recession, and it could be a very deep and thorough recession. Okay, so he's given a lot of concerns about that, and that's something that we've got to take away and we've got to be concerned about in the upcoming months, especially from the UK standpoint. Okay, so all right, there was a rise in that, but what was also coincidental sort of to that, and something that I wanted to keep my eye on, was the MPC rate vote. Now, I'm not sure if you guys remember the previous rate decision that had taken place by the Bank of England. It was a mismatch between the votes and the members in the MPC, right? So these are 9 members, and what they're going to decide, how many of them are going to be hawkish, how many want to keep it neutral as it is where it is now, right? Or how many want to be dovish, as in look for a rate cut, right? The last bank vote, there was one person that wanted to keep it unchanged, or 2 keep it unchanged, 3 were looking at hikes, and 3 were dovish or something like that, right? So there was a complete miss in regards to them all being on the same page. Okay, so, and that's what I wanted to see this time, is that was there still miscommunication amongst them as a team, or are they all on the same page? And it seems that they are all on the same page at this moment. So yes, they all raised rates given what's happened. Now, it was good to see that we didn't have the budget review, okay, that we're expecting now. I believe it's on the 17th of November. So we'll wait and see what takes place from Hunt and Co. Hunt is now the Chancellor of Exchequer, taking over from Kwasi Kwarteng. Now, if Rishi Sunak and Hunt go on to sort of put in their budget review, this is not a review that's taking place, well, we need to see how that's going to really impact markets. But so far, we see some stability from the market's perspective. Okay, so the markets are taken on board what's happened. They're now stabilizing a little bit, but let's see. That's where there is a lot of risk at this moment. Okay, from a fiscal standpoint. But okay, Bank of England raised rates. They gave us they've given us a very strong warning of a recession. Let's see what takes place on the cards to that, right? And then the rest of the week, we go into towards the end of the week, the most anticipated, the first Friday of each month, we see non-farm job report, okay, labor force results. Now with this, now the market's actually expected a lower number, right? So if we look at the non-farm employment change and we just look at well, I want to remove that section there, right? Okay, we just want to focus on so far. There we are. Okay, so you can quickly see that the markets are beginning to price in lower numbers. If you look at this little orange bar over here, right, this is what they anticipate and what they are expecting, right? This is what the market is pricing in. And it's showing lower numbers. It's showing lower numbers of job changes taking place, right? Now, it was quite a surprise, actually, that it came in at a much better number, right? So the markets are forecasting 197, but it came in at 261, so it came out at a higher clip number, right? Now, the market is anticipating a lower number because there is a slowdown, right? We know if you are monitoring what's happening from a microeconomic standpoint, where you're looking at individual companies and you're viewing, we just admit someone in, and you're viewing how are they performing and what are they doing. We know that there is a lot of job cuts taking place. So the market's anticipating, okay, there's less jobs being created. At the same time, there's job, there is cuts taking place. Now, I'm just looking if there is a tracker actually that I've seen. Now, I'll come back to that in a second. Okay, so, but actually it came in at a much better number. Okay, so that came in at a better number. So the markets, at the same time, whilst you're seeing that, okay, the employment change number came in higher than anticipated, so much better than hoped, but at the same time, what you also got to be concerned about is this number here. This is your unemployment rate. Now, it's previously at 3.5%. That's a very low number. These are record low numbers, right? From pre-COVID levels as well. Yep. So it was anticipated to go up a little bit, okay, but it came in slightly higher than anticipated, which is at 3.7%. Okay, so we'll just have a quick look at that. So that's what you see. So pre-COVID, where we saw unemployment of 14% at one point in the US, where if you look at the pre-COVID numbers, they were around 3.5% as well. Okay, so that's the lowest it's sort of achieved, was like that 3.5% was in January 2020. Okay. Prior to that, 3.6, 3.7 in that region there. So we've seen record numbers, and that number drops substantially to what we've seen recently at 3.5. Now it's gone up to 3.7%. So the question is, are we seeing that knock-on impact, right? Are we seeing, okay, that supply chain, whether it's the demand side and supply chain issues that we're seeing a concern, or it's inflation, there is that view that the markets are moving away, and liquidity being taken out of the system is going to make it even more difficult. So there is markets pricing in that we're going to see unemployment rise in the upcoming 3 to 6 months. What showcases that is this website here. If I just bring this up, so someone's put this together very, very nicely. It's taken it from a number of sites, but okay, what we've got is a layoffs tracker, right? So these are some technology is fantastic nowadays that you can sort of keep in the loop of what's taking place. But okay, so not only can you watch Elon Musk fly on his jet and know exactly where he's going and how much he's using his jet on a should we say daily basis, right? But you can sort of track what's taking place from a job standpoint. So looking at the, should we say, tech, this is more tech focus, but if you're looking at some of these tech companies, look at the number of layoffs that are taking place. Well, we know what's happened with Twitter, right? Elon Musk has stepped in, he's laid off 50% of the workforce. Okay, so 3,700 jobs gone last week. Okay, at the same time, you're looking at some of these other big tech firms, whether you're looking at Stripe, down 14%, Lyft is down 13%, and you can go through this list and you can pick up some of those well-known ones that Zillow down 5%, Even read just this morning that Facebook, what's happened with their share prices and so on, they are also looking at cutting jobs at this moment as well. So this will be a good tracker for you guys to, I might just share this link in the chat. Nice. There you go. Something to sort of keep an eye on an ongoing basis, and just to sort of show you what's happened most recently. What we're seeing here is the $1 trillion market cap club, right? So these are companies that once hit a valuation of $1 trillion based on the share price, right? Now look at them. Now where are they, right? Now you can clearly see Meta being the one that has taken most of the brunt there, down 76.69%. Okay, and Apple's also not faring so well either, almost down 25%. We've seen a bit of a disaster, especially from a Meta standpoint, and we're expecting further job cuts to take place, especially from what I've just read recently about Meta in particular. So yeah, it's not looking so great. Just looking at the index of the hair of these stocks, right? They are down over a 5-year view from where we reached the peak at the beginning of 2022, so year to date wise, right? Okay. So yeah, employment levels was another very key area of focus. Okay, we've got a large number of jobs being created, but at the same time, we've seen a high number of unemployment rate going up from 3.5 to 3.7%, and that's likely to continue and really have a more extensive concern in the economy. Okay, so yeah, we spoke about employment levels. Now another area that is not on my economic calendar here, that's something that you need to keep in the loop of, especially that from what I've read over the weekend, is the ongoing conflict with COVID, okay, in China. Yeah. Now, say conflict, is it? It is a conflict, isn't it? Really, it's something that they are fighting, and what we're hearing is that China has a very strong zero COVID policy. Okay. And what that means is that has an economic impact, right? If we see major shutdowns, restrictions occurring in some of the major cities in China, that's going to have an impact on the supply chain and then have a knock-on impact on other areas as well. So that's something that I will maybe touch on a little bit more and expand on in a little while. Okay. Yeah, and that's the sort of the overall review from last week. Now, for the week ahead, you're going to continue with the ongoing rhetoric, as I mentioned, in regards to, hang on, let me just bring up this week. Yeah, so the ongoing sort of, news of what we're hearing in regards to COVID in China, that's something that I'm going to keep my eye on, because what we're hearing was last week, Thursday, Friday, when we heard news of this, what we anticipated that they're going to move away from the zero COVID policy, okay? And that was what markets began to price in. But then what we heard over the weekend and overnight is that no, they're not moving away from that zero COVID policy, okay? They are going to potentially bring this into force. And I can't remember the exact number. I've got it here. It's written on my notes there anyway. I'll bring up later. But yes, you've got to continue to watch out what takes place in regards to COVID, especially in China. Now going on to tomorrow, where the focus is going to be going into the US midterm elections. I'll touch on that in a little while as well, what we're going to speak, some key areas there. But okay, we've got this elections, and those that can have an impact on the markets, right? Now, what better example to use is from the UK politics in the most recent weeks, right? What do we see in the UK politics, right? We saw when Liz Truss took the top office in the UK, right? Became PM. Within 44 days, she was out. 44 days she was out. And in those 44 days, right, how much volatility do we see in the markets, right? What do we see in the pound? And what do we see in the FTSE? We saw big movements occurring, a lot of volatility coming in. So that just shows the correlation that you see from a fiscal standpoint, from a governmental standpoint, okay? So I don't obviously expect as much of a volatility to occur with the midterm elections, that's for sure, to what we saw with Liz Truss and co. But hey, that there could be some area of movements to occur in the markets. Just be careful how you manage that. Speeches, there are a number of speeches that are going to come through. So we've got MPC member Pill to speak on Tuesday. If you look at some of the sort of, other, well, Haskell's going to also speak on the Wednesday. We've got RBA, Deputy Governor Bollock will be speaking as well. So yeah, just be mindful of central bank speeches from, I think, 7 central bank speeches to be expected, right? Okay, going into towards the latter part of the week, now the focus comes onto the key macroeconomic data. What is that? Inflation, right? So we have the US CPI coming out. We'll hear more about this. Now, is this the one that we're going to see where it does that downtick, right? Another downtick, right? That's the sort of the key point, and that's what we sort of need to focus on. Is this CPI inflation report is going to be very important because it will certainly bring hope to the market that inflation has, we can't say in check, but is the policies that we've seen by central banks, is it working? That's what we want to see, right? Is it having an effect? Okay, now just looking at sort of the big picture view, we had inflation come in at 9.1%, was the highest in July of 2022. We've seen a slow trickle to the downside, right? And the question is this are we waiting for the next leg higher to occur in inflation, or are we going to see it stay broad and sort of in this region, or are we going to see a continuation to the downside? Okay, so those are sort of the 3 sort of views in the market at the moment. So yeah, I mean, if we see this come back in line to 8%, that's going to be very optimistic for the market. So inflation is a strong focus this week. And then at the end of the week, you've got the UK GDP month-on-month figure. And that's it, really. That's it in regards to, yeah, there's always the University of Michigan sentiment reports that we have at the end of each week anyway. Okay, so, that's what we have on the cards. At the same time, you've got COP27. Is it 27? COP27 taking place. Who knows where that's taking place? I know where it's taking place. I'm heading there in next month. Not there. There we go. Egypt. Whereabouts in Egypt is another question. Where is it taking place? Not in Cairo. No. Not in Cairo. Maybe I'm wrong there. Let's have a look. 27. Yep, it's not in Cairo. Yep, Sharm El Sheikh. Exactly. So I'm heading there in a month's time. Having a family holiday out there. But okay, yeah, so COP27 is taking place, and what we're hearing, what I've read this morning, is the fact that we've seen now there's a duel taking place between Boris Johnson and the new PM Rishi Sunak. So they're both heading out there. They're both going to be speaking out there. At one point, we were hearing that Rishi Sunak wasn't going to go out there. So yeah, they both are going to give their interpretation of what they should be doing from a climate standpoint. But okay, we've got COP27 taking place in the background as well. All right, now moving on. We'll have a look, a quick view of the markets. I'll just move this up away. Moment. Okay, so from an equity standpoint, like I mentioned to you guys already, so look at the technicals now, right? Now, we've seen a bit of a bullish move taking place in the S&P 500, looking at the 4-hour time frame, right? So, and why is that bullish move come into place? Like I've just mentioned to you. So we've seen most recently, inflation numbers are starting to drop ever so slightly, shall we say. At the same time, we're seeing these larger rate hikes taking place, but the view is that that's going to eventually cool off. It's going to slow down, okay? That's the view. But what we saw last week was not the case, right? And that's where we saw the move lower. And that sharpish move lower is that the Jay Powell and co are not going to slow down. They are going to be very hawkish. They are going to be very, really trying to grip inflation and really bring it down. Okay, but then there's some hope being sort of priced at this moment. So we saw so if I take this as a technical, we've got the downtrend in place. This downtrend's been in place for some time. So we're looking at from the 16th of August going to the lows of now the 13th of October. And since then, we've seen just 3 to 4 weeks worth of a bullish move taking place. But then that was quickly scuffled with Jay Powell and co. in regards to their hawkish rhetoric. But is that enough to put off the market? Is that going to be enough to put off the market? Because their view is always the forward view, looking at what's going to take place in the upcoming months. So the inflation scenario is going to be very key. If inflation is tamed, if inflation is dropping, it's moving lower, then we can continue to see potentially a retest back into the 3,900 region, or even higher up to around the 4,000 figure, the S&P 500. Okay, so that'd be sort of the key points to take away from there. Now, looking, let's have a look. What else do I want to sort of look at? Let's have a look at the dollar, right? The dollar being in focus, coming up to, okay. Should we have a look at the daily picture view? Okay, so this is what we're seeing on the daily picture view. Now, the dollar is extremely elevated. There's a lot of strength that's come through, and that's been the knock-on impact from what we've seen with interest rates. Okay, so if interest rates are being hiked, right? So we're seeing, interest rates at these higher elevated levels, then we're going to see that knock-on impact in treasuries, and the bond markets, where the yield is gaining at the same time. And then that has a knock-on impact on the dollar index. We're seeing now the dollar strengthen in this inflationary theme at this that's taking place around us. But the question is, the market is going to be very looking forward, right? Has that inflation been controlled? Is that inflation beginning to come off a little bit? And that's where the focus is going to be in regards to the US dollar index. So let's mute that for a second. Okay, so now the US dollar, it should have actually performed much better, though, given what we saw with the non-farm payrolls, right? That's just the key point there, but it actually failed to do so. So again, we had a bit of a move higher, and then we're seeing a bit of a drop taking place in the, and I think, what we could be seeing is that we are in the medium term, potentially, at the most elevated levels, and we could be seeing a top potentially being formed now as well, where the market may stay range bound for some time till we hear the next key scenario taking place. Okay, so that's what I'm forecasting at this moment. I don't really see that we're going to break these high levels of these, the 114, the 115 handle as of yet. We could see some balanced trading around the 110 handle, maybe a clip higher or two. Look at the key handles there, 111, 112, maybe back down as low as 108.20 in that region there. So what we can see is a balance taking place, a consolidation zone for the dollar index, right? Looking at the euro, if we look at the euro, bring up the euro now. Okay, so where is the euro? Well, retesting parity again. Okay, so the euro, it's underperformed, right? What did we have last week that was very important for the euro? Let me know in the chat, guys. What do we have going on the key theme I've already spoken about? What was one of the sort of key areas from a macroeconomic standpoint? Come on, guys, let me know in the chat. Okay, I'll give you a hint. Inflation. Okay, so what was the inflation report that we heard last week? What was the euro inflation report last week? How many of you know this? Doesn't seem like anyone. Guys, you've got to be on the ball. You've got to know this information, right? Well, it was 10.7% year-over-year figure. Okay, so we had a 10.7% year-over-year figure. Markets didn't like it too much initially, but then you can see there's a bit of a balance coming through. And that's where we've seen priced out retesting parity level, right? Yeah, so the euro is now being impacted not with the inflation theme so much, right? Just look at the correlation effect, right? So inflation is more important on the dollar side, and then if we're not now seeing that the dollar is not really strengthening as much as it previously did, and it's more of in a balance at this moment, or consolidation, then that's going to have a positive impact in the euro. So because of the dollar, the weakness that's stepping into the dollar, that's why we're seeing a bit of euro strength coming through potentially, and that's why we're retesting parity levels. Okay. Now looking at the pound, yeah. Okay, pound again, similar effect with the dollar as I've just mentioned. So we've seen a bit of a reversal in the previous week, where we're seeing even though the Bank of England raised rates by 75 basis points, but it is now expected that they may reduce what they do going forward. So they're not going to be as hawkish as they did in, like we've seen in the previous three meetings, I believe, where we've seen these 75 basis point rate hikes. So we could see them cooling off a little because of the concern that from an economic standpoint, the deterioration there is certainly that they need to consider that going forward. So, we may see a bit of weakness stepping in the pound, but at the moment, again, a lot of it's being impacted because of the dollar correlation. Okay, so when you're looking at a pair, you're looking at both sides. What you need to assess is what's most being impacted in the pair, right? Which one is the one that's really struggling or outperforming based on that individual currency. Okay, so there's more dollar weakness than there is sterling strength, shall we say, right? Okay, so those are sort of the key markets that you need to sort of be aware of when we're looking at the currency space. Going on to, let's have a look at oil at this moment. Okay, so oil retesting those highs again, so retesting that previous resistance that we've seen over here. Again, we've seen another breakout from the trend. Okay, so we've got this down trend line in place. The breakout, not really a very nice clean retest like we saw with the S&P 500. But okay, it came back to retest of the 82 handle. Round numbers are very important. Always pay close attention to those round numbers. And now we're back above to retest that previous stronghold at 94 handle. Now, will it go into 94 handle, 93 handle? That's where we're sort of testing at this moment. Will it really break through, or are we going to see another rejection at this point over here? So technically, that's what we're seeing here. Now, what's taking place from a fundamental standpoint? Well, there's not a lot much that I can say that I've not covered previously with you guys. There's not any more new information apart from the COVID scenario in China. Okay, that's what I'm debating at this moment, right? Yes, we saw OPEC Plus agree to a reduction in their production levels of 2%. That's 2 million barrels going offline, right? But then we have the US with their SPR levels, right? So the reserves that they're putting into the market as well to keep prices lower. Now we know OPEC Plus want to keep the markets, that they want to keep the prices elevated, but they don't want to be where it was previous, where we saw those, $130, close enough to sort of, at one point. But they do want to keep it in the region that we're seeing at this moment, right? So they want to keep it, somewhere between the sort of mid 80s up to the 100 mark, shall we say. So that's where we're seeing where price is at this moment. Now, the concern is if COVID is a big concern in China, there are restrictions, the demand for oil can drop even further, right? And that's where we're going to see a play on the demand side for oil, and clearly will that impact, that's going to impact prices. So we need to be aware of what's taking place in regards to the zero COVID policy that China has. Okay, so that's the oil market. Precious metals, do you have a quick look at gold? Gold has been one market that not playing out so well, retesting the, these lows here. This is, 1620 handle sort of, at a 3 tests at 1620. Okay, so 3 tests at this 1620 handle. Again, key number, key figure, you should be aware of 1620, right? Someone says to you, are you aware of the 1620 sort of figure on gold? You should know this, right? Don't just, visually remember a chart, also know these round numbers for these key numbers. You should be writing these numbers down. Okay, so we're now retesting sort of, the upper resistance level, somewhere in the region of 1680, 1678 figure over here that we're seeing here. So you can see sort of resistance in the hair, resistance here, resistance in this region. So we're retesting this. We could see a next run back up to sort of the 1720 handle at some point, right? So just be aware of that. But from a, well, again, you're going to see the dollar influence into this as well. Okay, so that's what we're seeing now. So if I see that the Fed may pivot, even though they've given a very hawkish view, that hasn't been priced in, dollar has hit this elevated level. It's not going to really make further stride to the upside. It's going to stay in this consolidated high sort of level that we've seen around the 110 figure. We could see then gold come into play as the recessionary theme grows. Okay, so people are now holding more precious metals, shall we say, safety assets, going into and where there's going to be some economic challenges ahead, depending on where you are in the world. So that's where I can see a bit more demand coming in for gold at this moment. But overall, if you're looking at the metal, we're looking at gold at this moment, it was unfazed by both Fed hike, right, and the strong NFP numbers, right? So it's showing good resilience around those two data points that I've just mentioned, right? And that could be largely because what we're seeing with the dollar index. So dollar index is a key asset at this moment when you're looking at some of these markets, right? Okay, looking at the bond markets, bonds, they fell as the Fed hiked rates, and that's been the case year to date, right? So we're seeing bond prices fall. Why are they falling? They are invertedly correlated to the yields. So therefore, if yields rise, the bond price falls, and that so-called 60-40 portfolio, that's not been working well at all in these market conditions in the inflationary theme, right? Where we're seeing both stocks and bond prices are down. Right? Crypto, should we have a quick look in the crypto markets? It's not been so bad in the crypto markets as of late. So, yeah, we're back above the 20K figure. So we're back above the 20,000 figure, looking at the price of Bitcoin. It really sort of went on to test a high of the weekend, I believe. This was on Saturday, yeah, of 21.5, I believe, it's 21,500, or just shy of that, 21,500 figure. And it's moved back a little bit lower, now testing around 20,740. Yeah, there is some bullish strides taking place from a crypto standpoint. And the question is, if I go to that bigger picture view, right? So that bigger picture view, have we bottomed out, right? Has cryptos, from those once levels that we were trading at one point, right? Looking at that really big picture view, are we likely to see, the price of Bitcoin even lower than this? I don't think so. I think, it's really found its floor at this moment. It's really sort of holding this 20,000 figure, or you could say somewhere between 18,500 up to around 21,000, and that sort of, strong sort of support zone. It's really holding that support zone, and it's stayed above that region as of late. So yes, it's potential that it may have found its key level of support given all the market conditions that we've seen, right? So inflation, there was once that view that inflation is positive for Bitcoin, but how much of that is being priced in? Well, not much, purely because what cryptos and Bitcoin in particular is correlated to is it being far right on the risk curve. Okay, so it's highly correlated with tech stocks, so growth stocks, as we've seen, and they are down 74%, but yet gold, or Bitcoin and crypto assets actually did really well last week. So even though tech stocks and growth stocks are really being impacted in the last few weeks, that's not being correlated in what we see in the Bitcoin price. And that's why I feel that, that bottoming out has taken place. And there may be more of an upside move than there is a downside move, unless we see a new big rhetoric come into play, a new big theme really impact markets. Okay, now and that could come through this week if you think about inflation. So, key point will be keep an eye on the inflation report in the upcoming week, this Thursday, and that's going to maybe have an impact in the crypto scene. But at this moment, yeah, I'm quite surprised given everything that's happened in the tech stocks in the last week or so. We're seeing Bitcoin elevated back above the 20K figure, and it's moving in a bullish trend as we've seen, so breaking those prior highs as well. Okay, so higher highs and higher lows, that defines the trend. Okay, apart from that, yeah, I think I've covered all sort of key elements there. Let's have a look through if there's anything else that I want to cover. Okay, so as I mentioned, something that you need to really keep an eye on is the China to stick with that zero COVID policy. Okay, so we heard that they are overnight doubling down, and that's going to really impact the optimism that we once assumed that was going to come into play into markets. Okay, so yeah, economically it can be very dangerous if the virus continues to grow. The cases continue to grow, because we're going to see big impacts from an economic standpoint. So I believe, so just looking at it, China reported its highest daily COVID caseload in 6 months on Monday. The country logged over 5,600 new COVID cases, right? And a large portion of that's coming from a specific province that is linked to being a manufacturing hub in the south of the country, right? So yeah, just be mindful of that. Now that what we heard from there, then we hear from Apple, right? So now these measures that are taking place are going to impact Apple. So Apple have just recently warned that its iPhone production is going to be limited. Okay, so we know that there's going to be a temporary impact to their production of their smartphones, and there could be long wait times ahead in regards to those phones. Yep, so we spoke about also it's 10 days left until an autumn statement. So there are 10 days left until autumn statement. UK Chancellor Jeremy Hunt, as I mentioned, is looking to sort of, plug that black hole that we've seen in the government finances. And that's going to be not so great if you think about what Liz Truss was doing. So there's a complete U-turn taking place. Liz Truss was doing a dashboard growth, right? Lots of tax cuts, but we're going to see Richard Sunak do the opposite. He's looking to, really control the purse strings, should we say. So we're certainly looking at a fiscal tightening taking place from a political standpoint, from a fiscal standpoint, and so on. Yeah. Okay. I'm just looking through if I've hit sort of all my key points there. Okay, so talking on to the final points of this session is, as I mentioned, tomorrow is that election day in the US, right? I'll just bring up the S&P 500. Okay, so tomorrow is that election day in the S&P 5, in the US. So we've got the midterm elections. So now, what I would suggest there is that, okay, this is what's going to be taking place. Now we know that all 435 House seats and there's 35 of the 100 Senate seats will be, available, right? It's going to be, that's the ballot taking place, right? At the same time, there's going to be 36 states that will elect their governors as well. So it's a big deal. It is certainly a big deal. How much that's going to be impacting the markets, that's limited there as well, right? So, election results really don't have, especially midterm election results, have limited impact on this stock market, regardless of which party gains or retains control of the House and the Senate. So that stated, the party with the majority can make huge differences in regards to their fiscal policies and getting them passed. And that could then have that knock-on impact in the stock market, right? But again, considering what we're seeing at this moment, I don't think that's going to be too much of a concern. So initially, I don't think this is going to be impacted so much. But if we see a big drastic change of these seats, then certainly what the policies that they bring through and what gets passed could have an impact, whether they are looking to be expansionary or contractionary. Okay. Now, what does that mean? Well, expansionary means, you are lowering tax rates or you're going to increase in spending, right? And it's the opposite of this contractionary, right? And if they go on to do that, that increases aggregate demand, and then that will fuel economic growth. Okay. So if we see lower tax rates and increased spending, that's going to have a positive impact from an economic standpoint, and that's where we see the stock market sort of rise and be more bullish. But if it's contractionary, where they are raising and continue to raise rates and they continue to cut spending, right, to go on to reduce inflation, then again, there's going to be more of a difficult environmental concern from an economic standpoint as well. So that's what you need to be aware of when it comes to the election. It's not the initial impact of who's won the seats. It's the policies that come once they've won the seats and how much of it's contractionary or expansionary. Yeah. So yeah, that's about it, guys. So we'll end the session here, and we'll go through a Q&A session, guys. We'll do a Q&A session.